What's up, y'all? Y'all ready to get started?
Hell yeah.
Yeah. Hi. Yes.
What's up, Robin?
Hello.
This
Who is this?
Trayvon, man.
Hey, Trayvon. How you
Yeah,
doing?
So I was gonna,
Oh my God, you look just like your
you
dad.
don't look like that.
Dang, that's crazy. You do. You look just like your daddy. Oh my gosh. It's good seeing you.
Good seeing you too.
uh, I was gonna give Chris just a, but we can get started because he pretty much knows what I'm talking about. All right. I want y'all to make sure y'all got pen and paper because it's a lot of content that it's hard to retain by just hearing it. So if you could do that, would be great. So let me change side. So what we're talking about is technical analysis. So technical analysis is basically um, the breakdown of reading the charts that are used to predict future breakouts, fake outs, sell offs in the market. So uh, ahead, I just have a textbook definition: technical analysis, a trading discipline employed to evaluate investments and identify trading opportunities by analyzing statistical trends gathered from trading activities such as price movement. So price movement is just basically when the price of the company goes up or down. Um, Another thing I want to talk about is technical. So there's two types of analysis that you can do for a stock: technical or fundamental. So fundamental analysis is basically you're studying um, the roots, the background of a company. You're studying uh, strategic plans that the CEOs have for the company. You're studying profits. You're looking at their annual reportings. And so the basis for fundamental analysis, it basically shows you the value of the stock. Is there potential in the stock, or is it a waste of time? But for the type of trading that we're going to be doing, we're going to be highly focused on technical analysis because technical analysis shows you what the stock is actually doing. So we make our investments off actually what the stock is doing, not um, off of the value. Well, you use the value of the company to select which stocks you want to trade, but technical analysis actually puts you in the trades itself. So fundamental analysis is more so for your long-term investments. You basically assessing to see if this company will bring you profits in the long run. Um, like I said, technical analysis is used to help anticipate future stock market movements. And so we're gonna get into a lot more detail on that, but I just wanted to provide you that foundation of actually what technical analysis is. I gotta do it like this. So technical analysis, like I said, we're studying charts, and so this right here, I don't know which company this is, but I just wanted to give you a visual of what a chart looks like, and um, I know it looks like Chinese at the moment, and I'm gonna break it down, but as you can see, price is going up and down. So to you might want to take a picture of this or draw some pictures of it. So these are what's called candlesticks. So you can when you get into um, your setup for your platform, you can choose to have candlesticks. You can choose to have a line graph, but I highly recommend the candlesticks, and I'll tell you why. So uh, when you trade, when you trade in a company and you're using technical analysis, you're looking um, at what the price is doing, whether each minute, each 5 minutes, each hour, each 15 minutes, however you want to set up your charts. But the candlesticks show you the impact of each movement. So each candlestick represents a time period that you selected. So, for example, if I was on a 1 minute if I was on a 1 day, 1 minute chart, each candlestick will represent each minute of the market of that stock. So, for example, I'm gonna break this down to you. So, uh, green is what's called a bullish candle. We talked about bullish last week, but for the ones who weren't here, um, you have a bullish and a bear market. Bullish means that the stock is rising. Bearish means that the market is falling. And so bearish is red, bullish is green. And so each candlestick shows you who's in control, with the buyers, which is the bull market, or the sellers, which is the bear market. So the body of this candlestick, it shows you, in a sense, the strength of the candlestick. Um, it shows you the movement at the top of the body is where the price closed for that session, and the bottom is where it opens. So to make it more simple, after when this candlestick forms, it's going to start where the open is. And say if it's a bullish candle, it's going to push up, and this top little line at the top of the body is called a wick. And so that'll show you how high the candlestick pushed up. And so at the top of that wick is the high for that time period, and the bottom of the bottom wick is the low of that time period. And then at the top of the body is where the market closed. So if you were looking at it, you would look at, okay, I see, say if the open was at $5 and the high was at 10, and then the low was at $3. So you would read this by saying, okay, beginning of this time frame, it opened at $5. It pushed all the way up. Uh, no, it opened at $5. It pushed down $3, and then it shot up to $10, and it closed at 8. So it shows you great strength in that candlestick. Am I making sense, or is it still kind of confusing in a sense?
I'm following you. It's kind of making sense to me.
Okay. Um, and the it's the inverse for the bearish candle. So it'll open, it pushed up to its high, pushed down to its low, and it closed at a price a little bit above its low. Not all candlesticks are that textbook, but that's just the basics to kind of give you an understanding. So the body is basically the meat of that candlestick: high, low, open, close, at that time frame. And I'm gonna give you all a tour of my trading setup so you can kind of see this a little better. Um, so although you may have a bullish candle or a green candle, it doesn't necessarily mean that it's a strong bullish candle. So like if you look at number 5, that's pretty weak. That's almost the same as a bearish candle. So what you can see is that it opened at a price, it shot up, and then it got rejected and it got pushed all the way down to the close. That doesn't show any strength. Versus you look at number 1, it opened and it just pushed straight up without any pullbacks. And so when you're looking at charts, um, when you're looking at charts and you're looking at these candles, you gotta understand the strength of these candles, because not all green, not all red are follow the bullish and the bearish market in a sense. So like you look at 10, it opened, and it pushed down, and then buyers stepped in and they pushed the price all the way up. So that's almost in a sense a bullish candle. So I'll give you all some time to either take a picture, write it down, because this aspect of understanding the candlesticks, it goes so far. Oh, there's Chris right there. Okay. Okay, next one. So with candlesticks, uh, with price movements, they form what's called patterns. And traders, we use patterns to predict or to anticipate future moves in the market. So these are um, the most popular patterns that you will see and that you can kind of predict in a sense, but it's not the only. I just wanted to give you all a visual of the patterns because I'll just tell you now you're not going to retain every pattern. And when you're trading, it's good to keep like you can get like a PDF version of a lot of different trading patterns, and you can like have them by your side or whatever. But you really want to when you get into actually trading, you'll find your own trading plan, your own strategy, which patterns you want to look for. So basically, patterns are distinctive formations created by movements of security prices on the chart and the foundation of technical analysis. Like I said, they are formed by price movements and the candlesticks of these price movements. So this is one of my favorite techniques to use because you're almost guaranteed a breakout. So in the triangle patterns, you have a symmetrical and you have ascending and descending triangle patterns. So what makes this so profitable is because these prices are getting pushed and until the tip of the triangle, and which is building up pressure, uh, and that causes a breakout because you have buyers pushing up, sellers bringing it back, but then that narrow for buying and selling gets so small, one has to take over, and so the definition it says price is squeezed into a corner, which is the corner of the triangle, and the pressure from the squeeze breaks out the price from the built up momentum. Um, and so with these, we to further understand this, we're gonna go through some more slides, but um, in the market, you always want to focus on breakouts, especially with day trading, because we want to capitalize on volatility. And volatility is fast movements, drastic movements in the market. So you're looking at 5-10%, maybe even more. You don't want to trade in a stagnant market, and triangle patterns will not happen in the stagnant market. And so we use this as well to also predict our risk to reward ratios as well, which we will get into later. And so we're going to support and resistance. And support and resistance is probably the most basic, but one of the most important aspects of technical analysis. And I can read you the textbook definition, but to give you a more relatable definition. So your resistance point is where when a stock pushes to a price, but it can't seem to break that price, and it gets what's called rejected, which means that sellers come in and they start selling, pushing the price back down. And so it's called resistance because the stock has resistance breaking that price point. And the support is where the stock falls, but it finds support at that price level, and it rebounds from it, and it doesn't break it. If that makes sense, that's as basic as I can kind of get it. And with the risk and support, resistance and support, it helps us find our entries and exits. So I can't give all the sauce right. We get into the next slide. I'll teach you how this helps your entries and your exits. You probably can manage your risk. But technical analysis use support and resistance levels to identify price points on the chart where the probabilities favor a pause or reversal of a prevailing trend. Indicators. So within each trading platform, these brokers, they have what's called indicators, and a lot of them are used to basically aid you in your technical analysis process to kind of uh, shape what you're looking for. You know, because you can look at a market. You know, you can set your support and resistance lines, but sometimes that doesn't give you everything you're looking for. You know, um, for example, I love the VWAP or the volume weighted average price because um, volume in the market basically tells you how strong a move is in the market. And with the VWAP, it shows you the volume. So it calculates the volume into with the price action movements, and it kind of gives you an average price to let you know um, is this really a breakout, or is it really a sell off, or is it really going to stay neutral? Another one I've been getting into is the EMA, exponential moving average, and the relative strength index. Basically, in a sense, all of these show you um, how progressive or how degressive a stock is, and that's important because it shapes you and it kind of gives you a clearer understanding. But at the same time, if you cloud your charts up with all of these indicators, you're not going to do nothing but cause confusion. So I would recommend, you know, you find um, one or two maybe that you like and you use that. And like I said, all of this stuff when I get into the Thinkorswim platform, it's going to be a lot more relatable. Um, so volume, all volume is it tells you how many people are trading that asset or company share at that time. And that's like you're gonna hear people talk about volume if you watch YouTube or read. And volume is the amount of people that's trading at that specific time. And so the more volume that a company has, the more supported that it is. The less volume, the less supported it is. So to give you kind of an analogy, it's like if you got you don't know anything about basketball, and then you ask one person who's the best player in basketball, and one says LeBron James, and then you go ask 20 people, and 20 people say Kobe. It's more, it has more of an impact because you say, okay, I'm gonna take these 20 people's advice over this one person, and this helps you to different to decide if a company is a breakout or a fake out. And a fake out is basically it looks like a drastic move is going to happen, but it actually doesn't. And a breakout is when it actually does, and that's where uh, the profit comes in. Um, Stock selection. So this is key because if you don't select uh, the proper stocks, whether it's long term investing, mid term, short term investing, day trading, you're gonna fail. So how I like to base my stock selection is I invest on the needs and the priorities of the economy. For example, in January, COVID hit, so I invested in pharmaceutical companies. Um, you invest in companies like Zoom, who profit from telecommunication, um, etc. And you also invest. So you have to be in tune with what's going on in the world. You have to be in tune with uh, political endeavors. You have to be in tune with uh, presidential um, desires. And so that kind of aligns. So wherever Congress and your president focuses the economy, that is a sector of the market that's going to grow. And that's the sector that you want to look into because it forces a lot of volatility and a lot of growth potential. Um, Another thing, when uh, in the pre-market before the market opens, when you setting up your watch list, you want to capitalize on companies with a strong catalyst. I can't emphasize that enough. Um, and examples of that are breaking news: Apple's releasing a new phone, Tesla um, produce a brand new, more efficient, great, spectacular car, type things like that. Um, opinions of well-known traders. So you'll see companies who have a price target increase, and basically a price target increase is these well-known investment broker, not broker, investment companies, which is filled with top investors, well-known, respected investors. They'll say, I see this company reaching this level. And so when that happens, that brings a lot of optimism to investors. Oh, if they said it has to be true. And so people will start buying, and when people start buying, it'll push it to that price, or it can go to the complete opposite. And this with the breaking news and the opinion of the investors as well. They can say negative things or terrible, for example, Facebook getting sued or something like that, and that can cause an inverse reaction to the market as well. Earnings calls. So quarterly, each company has to report their earnings, and the market will put out a prediction of how much they think that company earned. And typically, if a company beats their earnings, it will cause a lot of optimism, a lot of positivity behind the company, and that can provide a strong catalyst as well and push it up. But like I said, that can go in the inverse as well. Political and social unrest. So if there's a lot of uncertainty in the economy, COVID, the investors and market really don't know what's going to happen next. That causes a lot of volatility, and we want to capitalize on those companies as well. And you want to hunt for companies with strong volatile chart patterns. For example, the triangle pattern. You want to look for those companies that have great setups to maximize your profit chances in the market. Everyone following. Okay. Okay. So things are finna start getting put together a little bit now. So I have this in all caps for a reason. The most important aspect of trading is risk management, because the trading provides an unusual environment, because you're constantly in the chance of potential loss, potential gains, and through research, through experience, in order to be a great trader, you have to be a good loser. You have to be able to be disciplined enough to where if a market hits your stop loss, you get out and you cut your losses small, and you don't take those big losses. And you also have to have that discipline to follow your trading plan at all times. And so, how I said the support and resistance lines can help you with your risk management. So if you see this price, this company is moving within the support and resistance that's been set. I don't know which company this is, but it provides a great example. So you always want to have at least a 2-to-1 ratio. So if you see whoever this investment was, they entered in at around 29.78, if I had to guess. They have their stop loss set at 29.72. Their target profit target at about 291. So that's a little over a 2-to-1 ratio, because he's risking $6. Well, a $6 move, he's willing to take that loss to get a $13 move up to the upwards. And so with these support and resistance lines, they help you get your entries and exits, because they show you, they give you, like, in a sense, a clear cut, okay, this is what I'm really gonna lose this way, instead of just going off the limb and saying, okay, it actually gives you a clear setup and real reason to why you have your stop loss where you have it and your target price where you have it. Does that make sense to everyone? I guess I should get off mute.
Yeah.
Does that make sense?
Kind of, sorta. I'm following you though.
Okay. So you see the entry point.
Mm-hmm.
The green up here is the target profit. So basically, what that means is when the price hits that point, as it did, that's where you take your profits and you get out of the trade.
Mm. Okay.
And this red line right here is his stop loss. And so basically, what the stop loss means is if the price breaks this, he's out of the trade. He's gonna cut his losses small. And so if you see, I wish I could highlight this right here. Can I do that? See, draw if that works. So if you see right here, bring it down a little bit. See this area right here?
Mm-hmm.
If that would have broke this area, this line right here, they would have been out of trade. But since it didn't break, they didn't get out of the trade. And
So who? I'm sorry.
and so this green line, when it hit right here, that's when he got out. So that's how you calculate your trade.
Des, may I ask a question?
Yes,
So who sets these margins?
you do. Well,
Okay. I'm
well,
sorry.
for this group and the stocks we're looking at, I will. But if you want to get more hands on, you do that. It's not already set.
Right. So I figured that. So I guess you're gonna teach us how do we, because it's like how do you know where to set them?
I'll show you that when we get
Okay.
into the
Oh,
when I actually show you like my actual trading platform. I'll get into.
okay. Okay.
Okay, clear out my drawings. Okay, look at that.